Welcome to The Explainer. Today, we're going to pull back the curtain on a world that usually operates in the shadows but, believe it or not, affects all of us every day: money laundering. We're going to find out exactly why your bank asks so many questions and how it's become a critical frontline defense against some major global crime.
All right, so to really get a handle on the defense, we first have to think like a criminal, right? What is money laundering really? And what's the playbook they're using to make all that dirty cash look squeaky clean?
Think of it like this. It's basically financial camouflage. Criminals take the money they've made from illegal stuff, we're talking drug trafficking, fraud, you name it, and they push it through this whole complicated cycle. The end goal? To make it look like it came from a totally legitimate job or business.
And here it is, their three-step playbook laid out for us. It all starts with placement. That's about getting the physical cash into a bank, maybe by breaking it into lots of smaller, less suspicious deposits. From there, they move to layering. This is where they create a tangled web of transactions, wire transfers, buying and selling currencies, bouncing money between different countries, all to make the original source impossible to trace. And the last piece of the puzzle? Integration. The now clean money flows back into the real economy, maybe to buy property or invest in a business. It looks totally legit.
Okay, so you see how sophisticated this whole thing is. How in the world do banks even start to fight back against this? Well, it all begins at the very first step, the moment you decide you want to open an account. I mean, it can feel a little intrusive, can it? They want your ID, a utility bill, they want to know what you do for a living. But, this isn't just the bank being nosy or wrapped up in red tape. This whole process, it's called customer due diligence, or CDD, and it is the single most important line of defense they have. See, banks are legally required to do this thing called Know Your Customer. All those questions they ask are for building a detailed profile of you. They're piecing together a picture of your normal financial life. And that baseline is absolutely crucial, because it's the only way they can spot when something happens that's, well, not normal for you. And what's really fascinating is how this process gets way more complex when we're talking about businesses. For a corporation, the bank has to peel back all these corporate layers to find the beneficial owners, the actual human beings who are really pulling the strings and benefiting from the money. It's a huge step to stop criminals from just hiding behind some anonymous company name.
So your account's open. Job done, right? No, not even close. In fact, that was just the setup. Now the real detective work kicks in, and it's all about continuous monitoring.
Think about this. Banks are using these super smart, powerful systems to scan millions of transactions every single day. These programs are designed to flag anything that doesn't fit your profile, sending up an alert so a real person, an analyst, can take a much closer look.
So what exactly is a red flag? Well, imagine your account just gets a regular paycheck every month, and then boom, a huge cash deposit shows up out of nowhere. Or maybe an account that's been sitting empty for years suddenly gets a massive wire transfer. Now, these things aren't automatically a crime, but they are absolutely the kind of red flags that legally require the bank to start asking some serious questions.
And it's not just about people who have accounts with the bank. Check out this number. In a lot of places, there's a specific cash limit, a tripwire really. If someone, a non-customer, just walks in off the street to do a big wire transfer over that amount, the bank is still legally required to check their ID and find out who they are.
All right, so you might think every customer gets the same treatment, but that's not quite how it works. Banks have to pay extra close attention to a certain group of people whose powerful positions could, unfortunately, make them targets for corruption.
These folks are known as politically exposed persons, or PEPs for short. And it's really important to get this straight. Being a PEP doesn't mean you've done anything wrong at all. It's simply a risk category. Because they have so much influence, the potential for them to be involved in bribery or corruption is just seen as higher, so banks have to be way more careful.
And this extra scrutiny doesn't just stop with the PEP. The bank also has to look at their whole inner circle. We're talking immediate family, close business partners, you get the idea. Why? Because those relationships are classic channels for trying to hide and move dirty money.
So here's where you can see the huge difference in action. For you or me, opening an account is pretty standard stuff, but for a PEP, the bank has to flip a switch to what's called enhanced due diligence. This means they have to dig way deeper, verify where the person's wealth actually came from, get a sign-off from senior management just to open the account, and then watch their transactions much, much more closely from then on.
Okay, so let's say an analyst spots something. A red flag is waving. Their suspicion is confirmed. What happens next? Well, a very strict, very confidential, and time-sensitive process gets triggered immediately.
And it can start with anyone, really. It could be a teller at the counter, a relationship manager, or an analyst in the back office. It's someone who knows their customer's account and sees an activity that just feels off. It doesn't add up.
So that employee can't just ignore it. They have to report it internally, up the chain of command, to the bank's chief compliance officer. That officer then does their own deep dive. And if they agree that something looks fishy, they put together a formal report and send it to the government's Financial Intelligence Unit, or FIU. You can think of the FIU as the Central Command for Financial Crime. They collect these reports from all the banks and connect the dots on a national level.
And get this, they are on the clock. That report has to be filed with the FIU as fast as possible, but absolutely no later than 2 working days after they form that suspicion. Speed is everything if law enforcement is going to have a chance to act.
And this next part is maybe the biggest rule of all. It is a cardinal sin in banking to do this. An employee is legally forbidden, it's literally a criminal offense, to tell a customer that they've been reported. It's called tipping off, and doing it could blow up a huge investigation, letting the bad guys move their money and disappear. Secrecy here is everything.
So you might be thinking, wow, that is a ton of work, a lot of rules. Why? Well, it's because this is so much bigger than just protecting one bank's reputation. This is about protecting the entire financial system we all rely on. When you choke off the flow of dirty money, you help fight the terrible crimes that it pays for, from terrorism to drug and human trafficking.
So when you think about it, your own financial footprint tells a story, doesn't it? Every tap, every swipe, every transfer. And with everything we've just talked about, banks are getting way, way better at reading that story and at spotting the chapters that just don't belong. Thanks for joining this explainer.